Hey everyone, welcome back to the channel. If there is one question I get asked more than any other, it is this. Where do you find these stocks? We have all been there. You have cash in your brokerage account, you are ready to invest, and then, blank stare. You look at the top gainers list, but it is too late. Those stocks have already moved. You look at the news, but it is too noisy and filled with short-term panic. You feel like you are just throwing darts in the dark, hoping to hit a winner. Most people think finding stock ideas is about being a genius who predicts the future. They think you need to know what the Federal Reserve will do next month, or which political party will win the next election. But that is not true. Finding great stocks is not about prediction. It is about observation. It is about having a system. Today, I am going to show you exactly how the best investors in the world, legends like Warren Buffett, Peter Lynch, Mohnish Pabrai, and Greenblatt actually find their ideas. We are going to move beyond the basics and do a deep dive into 4 specific, actionable strategies you can use today to stop guessing and start hunting. We are going to talk about leveraging your own life experience, legally stealing ideas from billionaires, finding market anomalies where selling is forced, and using algorithms to filter the noise. By the end of this video, you will not just have a few stock picks. You will have a permanent engine for generating ideas for the rest of your life. Let's get to work. Strategy number 1 is the simplest, but it is also the one most people ignore because it feels too easy. It is the concept of the circle of competence, popularized by the legendary fidelity manager Peter Lynch. Lynch managed the Magellan Fund and achieved a 29% annual return over 13 years, which is an absolutely insane record. And his core philosophy was simple. Invest in what you know. The problem with most retail investors is that they try to act like Wall Street analysts. They try to analyze biotech stocks when they don't know anything about biology. They try to analyze semiconductor chips when they have never built a computer. They are playing a game where they are at a massive disadvantage. But Lynch argued that you, the regular consumer, actually have a massive edge over Wall Street. You see things before they do. Think about it. Wall Street analysts spend their days in skyscrapers in New York or London. They look at spreadsheets. They talk to CFOs. But they do not stand in line at the mall. They do not notice that a new coffee shop is suddenly packed every morning at 7 a.m. They do not realize that your company just switched software providers because the old one was too slow. You see these things? Let's look at a classic example. In the 1980s, Peter Lynch noticed that his wife and daughters were obsessed with a store called The Limited. He went to the mall, saw the store was packed, saw the clothes were affordable and trendy, and he did some research. The fundamentals were strong. He bought the stock, and it became a massive winner. He didn't find it on a Bloomberg terminal. He found it in the mall. Or take a more modern example. Think about Apple. In the early 2000s, people who owned iPods knew they were revolutionary. They didn't need a financial degree to see that every teenager wanted one. If you had just bought Apple stock because you loved the product, you would have crushed every hedge fund manager who was worried about their quarterly earnings miss. So, how do you operationalize this? I want you to do an audit of your own life. Look at your credit card statement. Where are you spending money repeatedly? Is there a brand of clothing, a type of food, or a subscription service you would refuse to cancel even if the price went up? That is pricing power. That is a moat. Look at your job. What software does your company use? Is there a new tool that is making your life easier? Is there a supplier that is constantly raising prices on you because they are the only game in town? That is a stock tip. This is your circle of competence. When you stick to this circle, you are not guessing. You have proprietary data. You know the product is good because you use it. You know the customer service is good because you experienced it. That gives you the conviction to hold the stock when the market gets shaky. Strategy number 2 is for the efficient investor. It is called cloning. In school, copying off your neighbor's test is called cheating. In the stock market, it is called being smart. It is completely legal, and it is how some of the best investors in the world made their fortunes. Mohnish Pabrai, a famous value investor who turned $1 million into over 100 million, calls himself a shameless cloner. He openly admits that he gets many of his ideas by looking at what Warren Buffett and other super investors are buying. Why does this work? Because in the United States, The SEC requires transparency. Every institutional investment manager with over $100 million in assets must file a form called the 13F. They have to file this every quarter, within 45 days of the quarter's end. This form lists every long position they hold in U.S. stocks. This means you can look at the portfolios of Warren Buffett, Seth Klarman, Michael Burry, or Bill Ackman and see exactly what they own. Think about the leverage this gives you. These funds have teams of analysts. They spend millions of dollars on research. They fly experts around the world to interview management teams. They do months of due diligence. And then, they publish their findings for free in a 13F filing. If a brilliant investor like Seth Klarman, who is known for being incredibly risk-averse, puts 20% of his portfolio into a boring insurance company, that is a massive signal. It tells you that he thinks the downside is protected and the upside is significant. You don't have to do the initial screening. He did it for you. Now, there is a catch. You cannot just blindly copy these trades. There are two big risks you need to manage. First, the data is old. The 13F is filed 45 days after the quarter ends. So, if Buffett bought a stock on January 1st, you might not see it until mid-May. A lot can happen in that time. The price might have skyrocketed. Second, you don't know the thesis. You can see they bought it, but you don't know why. Maybe it is a hedge. Maybe it is a short-term trade. So, how do you clone correctly? You use the 13F as a lead generation tool, not a buy list. Go to a website like Dataroma or Whale Wisdom. These sites aggregate all the 13F data. Look for high-conviction buys. If a fund manager puts 1% of their money into a stock, that is interesting. If they put 15% of their money into a stock, that is a screaming signal. Then check the price. If the stock has shot up 50% since they bought it, you missed the boat. Move on. But often, the stock will be trading at the same price, or even lower, than what the super investor paid. That is the sweet spot. You are getting into the same trade as a billionaire, but at a better price. Strategy number 3 is where we find the most explosive potential returns. We are talking about special situations, specifically, spin-offs. This is the strategy that made Joel Greenblatt famous. In his book, You Can Be a Stock Market Genius, he outlines why spin-offs are such a fertile hunting ground for investors. A spin-off happens when a large public company decides to separate one of its divisions into a new, independent company. For example, maybe a massive conglomerate owns a fast-growing restaurant chain and a slow-growing steel business. They might decide to spin off the steel business so the market can value them separately. Why is this a gold mine? Because of a phenomenon called forced selling. Imagine you are a fund manager running a large-cap growth fund. You own shares of the massive conglomerate. Suddenly, one morning, you wake up and you have shares of this new, tiny steel company in your portfolio because of the spin-off. You have a problem. Your fund mandate says you only invest in large-cap growth companies. This new company is small-cap and it is in the steel industry, which is not growth. What do? You don't analyze it. You don't read the annual report. You sell it. You are forced to sell it because it doesn't fit your rules. Now, multiply that by hundreds of funds. When a spin-off happens, millions of shares are dumped onto the market indiscriminately. This selling pressure has nothing to do with the quality of the business. It is purely mechanical. This drives the stock price down way below its fair value. And that is where you come in. If you can step in and buy shares of a spun-off company while all the big institutions are blindly selling it, you can pick up dollar bills for 50 cents. Once the forced selling ends, the stock price usually drifts back up to its true value, generating massive returns for the patient investor. One classic example is when Marriott spun off its property management business. The institutions dumped the new stock because it was full of debt and looked ugly. But smart investors realized the debt was manageable and the cash flow was huge. The stock multiplied many times over in the years following the spin-off. To find these, you can simply search for upcoming spin-off calendar on Google. There are dedicated blogs and newsletters that track these. Look for spin-offs where the parent company is huge and the new company is small and misunderstood. That is where the opportunity lies. Finally, strategy number 4. The quantitative screen. The robot approach. Sometimes, the best way to remove emotion and bias is to use cold, hard data. A stock screener is a tool that lets you filter the entire stock market based on specific financial metrics. But most people use screeners wrong. They look for the cheapest stocks. They filter for the lowest P/E ratio or the lowest price-to-book ratio. The problem is that often, stocks are cheap for a reason. A company with a P/E of 4 might be about to go bankrupt. A company trading below book value might have assets that are worthless. These are called value traps. To generate high-quality ideas, you need to screen for a combination of quality and price. You want to find great businesses that are trading at fair prices. Here is a simple, powerful screen you can run on any free site like Finviz or Yahoo Finance. First, look for high return on invested capital, or ROIC. Filter for companies with an ROIC of over 15%. This tells you the company is efficient at turning cash into more cash. It usually indicates a moat or a competitive advantage. Second, look for safety. Filter for a debt-to-equity ratio of less than 0.5. This ensures the company isn't drowning in debt. In high-interest rate environments, low debt is a massive advantage. Third, look for earnings growth. Filter for positive earnings growth over the past 5 years. You want a business that is growing, not shrinking. Finally, look for a reasonable valuation. You can use P/E ratio here, but don't just look for the lowest. Look for a P/E that is below the industry average or below the company's historical average. When you run this screen, you will go from 5,000 stocks down to maybe 30 or 40. This is your hunting list. You aren't buying them automatically. You are using the list to identify candidates for further research. This quantitative approach keeps you disciplined. It prevents you from chasing hype stocks that have no earnings. It forces you to look at the fundamentals first. So, let's bring this all together into a workflow. How do you actually use these 4 strategies in your daily life? You need to build what I call an idea funnel. At the top of the funnel, you have your sources. Source 1 is your life. Keep a note on your phone. Every time you see a crowded store or love a new product, write it down. Source 2 is the 13F filings. Once a quarter, spend an hour on Dataroma checking what the super investors bought. Source 3 is the spin-off calendar. Check it once a month to see if any corporate divorces are happening. Source 4 is your screener. Run your quality screen once a week to see if any new companies have dropped into your value zone. All of these sources feed into your watch list. This is the most important tool you have. A watch list is not a portfolio. It is a waiting room. When you find an interesting company, but the price is too high, do not just forget about it. Put it on your watch list. Set a price alert. The market is volatile. Every few years, we get a correction. We get a panic. When that happens, prepared investors don't panic. They look at their watch list. While everyone else is selling because they are scared, you are buying because you have been waiting for this exact moment. You have done the work. You know the business is good. You were just waiting for the price to be right. Investing is not about activity. It is about patience and preparation. You don't need to find a new stock every day. As Warren Buffett says, you only need 3 or 4 great ideas in a decade to make a fortune. Stop waiting for the perfect stock tip to fall into your lap. Go out there and hunt it down. Thanks for watching. If you found this video helpful, please hit that like button so I know to make more content like this. And let me know in the comments, how do you find your winners?